Hello, we're going to look into the FTC data from the B2T engine. The FTC data is generated to support the calculation logic of the foreign tax credits for the parent company of an entity group. We know that when a company incurs foreign tax expenses, the U.S. tax authority, IRS, may allow the company to take foreign tax credits so that it is not subject to the double taxation by both the U.S. and the foreign countries. The B2T engine would automatically detect such foreign taxes and would automatically calculate the foreign tax credits for the current period as well as for the future periods in the form of deferred tax benefits. Here, we will look into a simple foreign branch example and briefly examine how the FTC calculation is being presented in the output file from the B2T engine. In particular, we will see how the relevant data flows from the account level to each entity's provision level and ultimately to the taxpayer level. The logic is rather involved, but the engine handles all that automatically. So here's our simple example input file where we want to calculate a US company P that has $1,000. Here, additionally, we tell the engine that there is a group of entities which has P as the parent company. And further, we tell the engine that we do want to calculate taxes for the group as a whole. Now, this calculation for the group would trigger the engine to calculate items of international taxation, which includes the foreign tax credit. In our simple case, as is currently, it is really rather trivial to calculate international taxation for the whole group because there's really nothing in it. Now, let's say that P has a Canadian branch and it also has a revenue of $1,000. So by doing so, we introduce some international elements in it so that the engine can produce some more meaningful number. So let's update this input file to include these more interesting business facts. So we tell the engine that there is another business entity named CH1. It's a Canadian branch, and it is subject to tax of USA in addition to his country. This is a Canadian branch. We also tell the engine that P in this group owns CH1 100%. Now, we also further want to tell the engine that CH1 also had a revenue of $1,000. And this is for the period, so therefore it's in the recurring input. And we want to tell the engine about the CH1's revenue. So here we tell the engine that CH1 has a revenue of $1,000. So that is it, and we're going to save the input file with all the added facts. We actually have such a situation. We have a P that has a Canadian branch, and we want the engine to do a full calculation for the whole group, which would include the FTC calculation. Now, just very quickly, the FTC calculation is really involves in a great deal is about aggregating of those FTC data, and the FTC data are the foreign income and the foreign taxes from those foreign income. And the calculation is done by the bucket. In the US, we have 3 buckets: in the general, then passive, and foreign branch now are in its own separate buckets. And those income and foreign tax items are being aggregated first at the account level, then aggregated into each entity's provision level, and finally reaching the taxpayer level. The taxpayer in this case is P, as we wanted to calculate its tax effects for USA. So let's go back to the input file. So here's the input file. We save it, and we are going to submit it to the B2T engine using this easy button. The engine appears to be starting code, so it may take 20-30 seconds to warm up. And we are going to, so it's down. Let's open the output file. So here's the output file. We see the calculation of two entities. Let's focus on the P calculation for its USA tax. We see on the income of $1,000, the tax expense is 60, which is considerably less than the 21% of the US corporate income tax rate. And we wonder why is that. So we go to the provision sheet for that calculation, P USA. So we go over there. And here we are going to take a look at the calculation of the current tax expense for P and the USA tax. The income is $1,000 and there's nothing adjustments. At 21%, we have 210 before credits. So far everything looks normal. Then we look further down, we see that there is a foreign tax credit currently creditable foreign income tax. So this is $150 that bring the tax expense down to only 60. So we kind of have an idea why the amount is less than the 21%. So how this FTC is being calculated as 150. So let's go down, skipping the deferred tax calculation and skipping the rate, and we want to look at the FTC calculation for P and its USA. Now, we talked a little bit earlier about aggregating by the buckets, the foreign tax and foreign income. Okay, now in this section, we have those buckets for each entity's provision. And those numbers are then further being aggregated in the next section. Those numbers are being added together, aggregated together in separate buckets for the taxpayer. Okay, so we see the foreign tax for the taxpayer is 150, and the total foreign income is 1,000, because we have a foreign branch in Canada that's 1,000. But the worldwide income for the parent is 2,000, because it has 1,000, but it also has another 1,000 from the foreign branch. With that, we then can calculate a foreign tax limit, which in our case for this bucket, in this foreign branch bucket, is 210, which is greater than the creditable foreign tax, 150. So the whole amount, 150, is currently creditable, which means there's nothing to carry back or carry forward. And the engine, in addition to determine the current benefit, it also tries to determine the deferred tax benefit from the foreign tax credit. We have nothing to carry forward, so therefore for the deferred tax benefit, there's nothing. And there is also this anticipatory benefit that the engine had been considering. This, in essence, is for the situation where the foreign branch, the Canadian branch, had a deferred Canadian tax. So it is not paying that tax just yet. It's deferred for future periods. But when in the future the branch is paying that Canadian tax, it would also have the U.S. tax benefit. Now, this future benefit is being anticipated, but in our case, there's zero amount in here. So even in our simple situations, we can see that the engine is considering thoroughly about all the situations to get the foreign tax credit benefits not only for the current period, but also for the future periods as well. All of these are being considered by the engine. Now, so this is it is by provision, it's a rather big, still a rather big buckets over here. How those big buckets data are being aggregated from the account level? That's the question. So we go to the further detail. Here we go to details. Let's first take a look at this in this bucket for CH1, for the CH1 USA calculation. Now we go to this detail of the provision calculation. We have the account level details on foreign tax credit for P, but is account level detail from its child, CH1 USA tax, because it's a foreign branch, but it is also subject to the USA tax. Now, this account level details is being calculated account by account. Each account contributes potentially to each of the buckets. In our case, it only contributes to the foreign branch bucket. And further, that each account, if it had a book to tax adjustments on it, there would be items over here. Each of those adjustments would potentially contributing to the those individual buckets as well. In our case, there's nothing. Okay, so the total FTC data, the foreign tax and foreign income, the total is aggregation of both from trial balances and from the book to tax adjustments. In our case, we get a result $1,000, and this is the amount. If we go back, this amount that showed up over here. So very similarly, because its branch is also paying tax to Canada, the foreign tax over here is being gathered from account level details as well. Let's take a look at, go to details. This is the provision for CH1 Canada. So FTC information from CH1 Canada. And we see again, the engine considers not only the contribution to each of the bucket from the account, but also the contribution from the book to tax adjustments to each of the bucket. And then both parts are summed together. In our case, we have 150. So Canadian 15% on $1,000 income, so it's 150. This is the tax that the branch pays to the Canadian government. So we go back, we see those account level contribution into the provision level bucket, 150, and these numbers add together contributes to the tax level numbers, and the tax level numbers allowed us to calculate the limitations, the current benefits, and the future benefits. So to summarize, let's go back to our original problem. We see The FTC data is first the foreign income and the foreign tax first gathered by the buckets at account level, then they aggregate it at the entity's provision level, then they further aggregate it again to the taxpayer level. Then the FTC calculation, the limitations and so on, is being executed. The B2T engine will automatically calculate the items of foreign tax credits for the parent company of an entity group. So the engine handles all that automatically without any user intervention. That's it. Thanks for watching.